So on Sunday, last Sunday, I was holding Ever, my almost 5-year-old, in my right arm, and I was stepping over a little ornamental fence on a street in San Carlos called Candy Cane Lane. And it's called Candy Cane Lane because all the houses on the street really go for it with their Christmas lights. So I lift my foot up over the 2-foot high fence, and as I'm lifting it over, Burgess is stepping over the fence too, and my foot hits her body, which I did not expect, but my momentum was already moving up and over the little 2-foot high fence, and I started accelerating to the downside, especially because my almost 5-year-old is in my right arm, and so she's helping me accelerate to the downside. And then life just kind of slowed down. I thought, and all these thoughts hit my brain. I can't land on my daughter. I don't want to land on my elbow. I got to get my daughter out of the way. I don't want to break my wrist or my arm. I probably don't want to land on my... And then by the time that happened, I had moved my daughter out of the way. It was a very jiu-jitsu-like move because gravity was pulling me down with momentum, and I had to move her up very quickly so she can get out of the way from my body. And the first thing that actually hit the ground was my right ankle. And all of my weight and my daughter's weight and the momentum and Earth's gravity focused in on one, square centimeter of space on my right ankle, and I tore a ligament. And look, in the world of things, tearing a ligament is not a big deal. It hurt badly for 10 minutes and has not hurt since. I was on crutches for 5 days. I have a walking cast now. I've had to stop working out for the week, though I will start next week. So look, it's not a big deal, but it definitely puts things in perspective. I mean, heck, my mom had stage 3 cancer 2 years ago and survived it. But it's just interesting how things just seem to get kind of messy, and you have to just kind of go with what's happening right now. And that's what I've been dealing with my torn ligament. I just keep saying, RC, this is where you are. This is what's happening right now. Yes, it's the holidays. Yes, you're going to go to Tahoe soon. Yes, you might not be able to go down the sledding hill with your 2 kids or go on the snowmobile, and Burgess is going to have to drive up to Tahoe. But this is where I am right now. And so with this week's podcast, I want to talk about kind of where we are in the markets and what maybe you should do about it. Hey everybody, this is RC Peck, and this is my weekend podcast. And the theme for this weekend is, and the winners are, I'm going to end up showing you 4 charts, but there's 3 main charts I want to show you, and I think they're actually probably the most important charts in the world. And I will tell you why each one of them is one of the 3 most important charts in the world. And then for fun, I want to throw in one more chart. So let's get to the 3 winners, the 3 most important charts in the world. And we could even say these are the 3 most important charts for 2016. So the first one is oil. Oil makes the world go around. Before oil was discovered, what one truck could do, it would probably take about 200 men to get the same thing done. And, it wasn't the truck being invented, it was oil being invented and the engine being invented. So oil makes the world go around. It is the most traded commodity on this planet. And as the price chart you see tells you a certain story, the red line, the smoothed red line on the price chart is the 200-week moving average, and it is falling, and it has been falling since the end of 2014. If you want something to go up, moving against a falling 200-week moving average is very difficult. Now, yes, there will be short-term moves up and corrections, but we have a long-term 200-week exponential moving average clearly falling. And oil is at its major 2009 low, where it bottomed at, let's just call it about $34, plus or minus a buck. And so that's where oil is today, which is incredible. It's done an incredible move down to $34 from a high of almost about $110 in 2014 down to $34-ish today. And what oil does matters because there's a significant amount of low-grade corporate bonds connected to the price of oil. So what you won't see with the three winners are the three most important charts of the world. You will not see junk bonds, because the only reason junk bonds are an issue right now is because oil has dropped from $110 to $34-ish. So what oil does here is very important to a lot of economies around the world, a lot of companies around the world. And if it keeps falling or stays low, then that's probably telling us there's something maybe not so good about the world economy, because maybe it actually doesn't need as much oil as the world thought. So I'm going to keep an eye on this. It can bounce around the $34-ish mark for many months, just like back in 2009. It didn't just come down, hit 34 and take off. It's been about 3 or 4 months figuring out where to bottom, and then it finally bottomed, and then it went from $34 and peaked right around $115. So oil is one of the most important charts, one of the three most important charts in the world. And this is not in any particular, like oil is the most important, but it is certainly the winner for commodities. Okay, the next of the three is the US dollar. Now, the reason I picked the US dollar is because it is the most used currency on the planet. And whether you like it or hate it or are disgusted that $3+ trillion of it was printed, or this country treats its currency badly. One thing I will say, since 1776, when the U.S. was formed, the U.S. dollar has been falling. So it's been falling for the entire lifespan of this country, and that is true for every other country on the planet. Currencies fall. But what we have here is the U.S. dollar in a sideways channel over the last year. It has not gone up. It has not gone down. It is consolidating. It is digesting this huge move that it made in 2014. And if you look at the price chart, and if you can't see the price chart, but you can hear my voice, the 200-day moving average is still moving higher, even though the actual price of the U.S. dollar being measured against a basket of currencies, the 200-day exponential moving average is still moving higher. So the direction, the momentum of the US dollar is still to the upside, even though the dollar is kind of stuck in a sideways trend. And until it breaks out to the upside or breaks down to the downside, kind of redundant, it's really just in a sideways pattern. There's no plunging, or I remember hearing, and I barely listened to the TV. Actually, I never listened to TV, but I read something on a blog post or something. Someone said, the US dollar plunged today. And it was this drop right here. That was the plunge that happened with the US dollar. And look, nothing in here is plunging or rising. It's just kind of going sideways and deciding what to do. But this is one of the three most important charts on the planet, because a lot of debt on the planet is also priced in US dollars. There's a lot of debt in emerging market countries that have their debt in US dollars. And as this dollar has stayed strong, or this currency has stayed strong and is moving higher, it's going to be that much harder for those emerging market debts to get repaid, because they're having to pay back with more and more expensive of their local currency to make up for the dollar. So if the dollar breaks out into the upside, my guess is it's going to really hurt commodities, which could maybe move us into a deflationary period, but we'll see. Now, I don't have interest rates on here specifically because I think interest rates will move on the dollar, and I know Janet Yellen raised the federal funds rate by 0.25%, announced on the 16th. Really, what's going to move this is, the dollar and the interest rates, they're very connected, and I thought with the price chart of this going sideways, and it's the most used currency on the planet, this is one of the three most important charts to watch. Okay, and the third and the last one is the most traded stock market index on the planet. There is no index that is more important for stocks on the planet than the one you're looking at right now, which is the S&P 500. And the S&P 500 has been in a sideways channel for 16 months. It doesn't know what to do. It is trendless. And I'm saying it's trendless because when you look at this 200-day moving average, It was moving higher, moving higher, moving higher until August of this year. It's fallen, it's gone up. It is trendless. You do not want a 200-day moving average to be flat, which it's been flat for almost the entire month of December. When you have a 200-day flat moving average, it means you got no trend. Even if that's not said with proper grammar, when you don't have a trend, you want to step back and take a break and be patient. You want to go with what's happening right now and not what you wish was happening. So we have to just be patient. Markets, prices hate being in a trendless situation. They hate it. The majority of the time, whatever it is, cocoa, coffee, sugar, S&P, oil, gold, things like trending, they do not like being in a kind of a trendless situation. But this is one of the three most important charts in the world, with the 200-day being flat. And you can see the closing of price for the S&P 500 as of Friday was below the December. At that point, it was the December low, but it broke below the November low. So next we're going to go and see how it does when it tests this September point. That's actually August right there. It had a pivot point in August and another pivot point right there at the same one and another one right there. So the next place it's going to want to test is this line. And I've been pointing this line out to you for probably about 9 or 12 months. My bonus price chart is showing you what the S&P, long-dated U.S. bonds, gold, and the U.S. dollar did since the close of market the day Janet Yellen announced that she was increasing rates 0.25%. So let's just start at the very top here where the black line is. That red line right there is the S&P 500. And since Miss Yellen, Madame Yellen, Chairman Yellen, announced that she's raising the interest rates 0.25%, the S&P 500 is down almost 4%. It's actually down negative 3.85%. So, but let's just round up and say it's down almost 4%. So that's interesting. Now, look, it's only been 2 full trading days since the close of her announcement, but still, the market's down about 4%. The next one, this green one, that green one is gold. And notice gold dropped the next day and then went up the day after that. So gold is actually down 0.7%. Only 0.7%, relatively speaking. That's great considering what's happened to the stock market. But it is still down right now. It's just kind of finding itself and figuring out if it should continue falling or find a foundation, a base here. The next one down is, I guess that's violet. I don't really know what color that is, but that's the US dollar. And the US dollar is slightly up 0.35%. So it has strengthened the dollar, which makes sense because if our interest rates are higher than, say, Europe, and we're the most stable currency, largest stable currency on the planet, then people are going to want to buy dollars and sell euros or Swiss francs because we have that stability right now. And then lastly is the long-dated U.S. government bonds, so 20 plus years. And if you look at it, this is really the winner. This is the winner right now. That's actually TLT you're looking at right there, the ticker symbol TLT. But they're long-dated U.S. government bonds, and they're up 1.7% over the last 2 full trading days. Now, guys, look, 2 trading days does not do anything, but I do find it interesting, and I'm going to continue to watch to see what does well and what doesn't, what has more strength and what has more weakness since the announcement on the 16th. The takeaway is, got to be patient. We have to be patient. And I never know which patient is patient. Is this the one where you're calm, or is this the one where you go in and see the doctor? Words are never my thing, but the key is to be patient. The US dollar has to break out of the channel. Until it does, there's nothing really to do. Oil has to find a bottom. If it doesn't find a bottom, it's going to create havoc in the junk bond market. That's why I did not have junk bonds on here, because that is not a major price chart of the world. Oil is actually what's driving junk bonds right now. But oil does have to find a bottom and the S&P needs to find a direction. Even if it's down, it needs to find that direction up or down. I did not include gold because gold is not driving the story right now. It is reacting to what's happening with the US dollar and interest rates. I did not include the CRB index, which is the commodity index, kind of the S&P 500 of commodities, because really the big story right now is really oil and the US dollar. And I did not include interest rates right now, including the yield curve, because that is moving off of really the strength of the US dollar right now. So I'll keep an eye on it. I'm very thankful for you guys to be in your world. Thank you for that. We have a couple more of these weekends before the year ends. And this is really just another step in helping you secure your future and secure your portfolio. Until next time, this is RC Peck.